Vidushi. Hello. Hello, Vidushi. Cat is out of the box, huh? Okay. Uh, Fine. Just give me a second. So, what is an umbrella organization? A company generally see umbrella organization. You can say that a company which is Tata is an umbrella organization, right? They are doing lot of different businesses, so that is kind of the umbrella organization. When a particular company which is having the different products in the different category, but there is one mother company, then the entire organization is known as umbrella organization. ICC Bank is an umbrella organization. Fine. So Tata is an umbrella, Tata and Sons. So for Tata and Sons, we will call it as an umbrella organization because they have TCS, Tata Advanced Defense System Limited, Tata Motors, Tata Salt, means they are involved in the beverages businesses. They are involved in FMCG. So in the various category, they are doing a business, but there is one parent company. So for that kind of the firms, we can use this term. What we can use this term, umbrella organization. Okay. So we have to start. Is it clear, Saurav? Hello everyone. Actually, there is an issue in this pen tab which I'm using to annotate here in this PDF. So I have to wind up the session for a minute and then I will start again. So I hope this problem will be solved. So just give me a few minutes. I will restart this session. Huh? Just give me a few minutes. So, okay. So, good evening, everyone. I'm sorry for this unfortunate delay. So, in the last class, we have completed what the organizational structure of banking in India, right? Organizational structure means what kind of the banks in India we do have. All these things we have completed in the last class. And I told you today I will start with what? Today I will start with risk management in banking system. Risk management in the banking system. Banks are an organization which do the function, means their basically function is what? Lending by accepting deposits. This is the basic framework of a bank, right? Though there are the certain banks like merchant bank and other things, investment banks, there are the other things. But in general, what is the meaning of bank? Bank means as an organization which lend the money by accepting the deposit, right? So you accept the deposit, and on the basis of that deposit, hello. Oh, अभी आ गया. So they accept the deposit for the purpose of lending. That is the base of doing a business for banks and especially for commercial banks. Right. So when you are a kind of organization which is lending the money, right? But that is not your money. That is the money of others, right? Especially the common man who save the money out of their total income, right? Or you can say the hard earned saved money is going to be deposited in the bank. And generally when people will deposit their money in the bank, they have this feeling that banks are the safest way of converting the savings in investment, right? So most of the time people will put their money in the bank with this perception that banks are least prone to risk, right? With this perception they deposit their money in the bank, and bank will do the business on the basis of the deposits they have accepted. Though there are the other sources, but what is the primary way of doing a banking? This is what I am discussing. So there is a company, or you can say a financial company, and there is a bank, right? So this financial company is using its own money, right? It's using and their own money, whereas bank is using what? Deposits to do business, right? Deposits to do the business, and they are using their own money. So when you are going to lend the money, whether it is a financial company which is lending the money, right? Similarly, banks are also lending money. Fine. So if a financial company which is going for lending, which is lending its money, and there is any issue, right? Means the borrower or the person or the company which took borrowings from this financial company, that company went bankrupt, or there is an absolute loss. There is an absolute loss for whom? There is an absolute loss for this financial company, right? So maybe there is a loss for a particular company only, a particular individual, or only just group of individual who are very financially sound. They are very financially sound. That's why they have established a company for the purpose of lending only, right? But in the case of bank, generally banks do accept the deposit, and accept the deposit from whom? The common man who have small savings. So small hard earned savings people are going to put in the bank, right? And that deposits are going to be used for the purpose of lending. Fine. So in the case of bank is going to lose its assets, right? So this is not only for that particular bank. This is going to question entire what? Banking system. The entire banking system is going to under the question, and the trust of the people, especially those people have small savings, their trust is going to be broken, right? So that's why banks banks before going for a business, this business, especially in terms of what, especially in terms of lending, they must follow certain steps so that their lending should be least prone for a loss, right? Least prone for loss, sorry. So the entire process under which bank is going to calculate ki what kind of the possibility of loss is being there, how much possibility, what possibility, how much possibility, higher possibility or lower possibility, what kind of the possibilities are there. The study of that particular thing is comes under the preview of risk management, right? Risk management. But management itself is a broader term. It is not just limited to what, identification. It is not just limited to what, identification of risk. Identification of the risk, right? After identification, plan A, proper strategy, right? Then contingency plan, or in the common word we can say that is what is plan B. Means if suppose that there will be a loss, then how this loss can be covered, what are things can be done, right? So all these things will come under the risk management principle, right? So the first stage, the identifying the risk, right? Identifying the risk, plan a proper strategy, plan a proper strategy ki how we can cope it up that risk, or how we can mitigate that risk, how we can minimize the risk. All these things have to be done at banking level, right? But at banking level, bank is supposed to do all these things on its own, right? But doing this work, risk management, it is going to involve lot of human and mechanical resources. It is going to involve lot of human and mechanical resources. Fine. And to get that mechanical resources and human resources, bank have to deploy some monetary sources. So sometimes bank feel that it is what, it is little bit difficult, or it is very kind of assets consuming, or there may be lot of expenditure. So maybe bank is not going to do all these things on its own, right? Or the guidelines are there, but those guidelines are not properly implemented, right? Those guidelines are not being properly implemented. So that is why it is very important for regulator of banking system. That is very important for regulator of banking system, just not only to supervise all these things, not just only supervise all those things, means कि bank is properly identifying the risk or not. Bank, if it is not doing the thing, means identification of risk properly, then RBI have to give the set guidelines कि these are the guidelines you have to follow for the purpose of identification of the risk. Then RBI must also have to monitor a proper structure or strategy is being there or not. What about the contingency plan? And whatever the contingency plan, we must have to provide a statutory framework with the help of government, so that in case of what assets loss, bank can try to go for what? Bank can try to go for some recovery, at least some recovery, right? So bank is going to do this thing. RBI is going to be vigilant. RBI must have to be vigilant whether the bank is going to do all these things properly or not. Apart from being vigilant, wherever if RBI is going to find it out, RBI is going to find it out that these things are not happening properly, then RBI will choose in this system, and wherever it is required, RBI can intervene, right? So the set of rules and regulations which is being put forward by the RBI, we generally call a camel system. Camel system. Under this, RBI has set the guidelines, and when these camel guidelines are not being implemented, then RBI will go for prompt corrective action, right? So both things are available there. So there is a risk management by the bank have to go for that risk management by following all the detailed guidelines given by the Reserve Bank. Apart from the Reserve Bank guideline, if bank want to perform with the Excel, how the bank is going to perform with the Excel? All their assets are going to perform. That means bank is performing well. So to make sure that your all assets are performing, you have to do the stress testing or stress management or the risk management in the proper manner, right? So some innovative steps bank can take, right, apart from the guidelines given by the RBI. So bank can take initiative on its own. Apart from bank's initiative, RBI is also having the watchful eye on the risk management of the bank. Fine. And if bank is not able to perform or bank is deviating, then RBI will step their shoes in this entire process. And if it is required, then they will go for prompt corrective action. Basically, the prompt corrective action, prompt and corrective action. Prompt reply means quick, right? Corrective action. So prompt corrective actions, basically they are two types. One is what? One is mandatory and other is discretionary. Mandatory means RBI have power to do that thing and you have to follow, right? So there are some mandatory steps on RBI. If the PAC framework is applicable, then RBI must do those things. Whereas there is some set of rules which RBI can apply on its discretion. So we will call it discretionary and statutory prompt corrective action framework we will discuss here. So what we are going to discuss this entire lecture is, first we will understand what kind of the risk bank may have to face. Second, how banks generally try to cope up with those risks, what are the mechanism is there. Then we will see that apart from the banks, what is from the RBI side, being as a regulator, how RBI see or oversee the bank's risk management, and if in case of any crisis, then how RBI will step in and try to resolve that issue. And when the issue is not able to be resolved, then how we can go for recovery, right? So this is also the part of risk management in the long and last step of the risk management. Means risk is there, you did the business, risk was involved, and finally what you are of having a fear. I was having a fear that maybe I will lose, and ultimately you lost and fear come true, right? In that case, how you can recover at least some assets. So SARFAESI Act, Banking Insolvency Act, right? Bad bank, all these things are the part of last leg or the last stretch of the risk management, right? So we are going to discuss one by one. First, how banks generally go for risk assessment and their management, then from what RBI side is being there. Okay. Do you have any questions? Because I am not able to see any comment here. Are you getting my point or not? So just write a comment so that I can proceed further. Otherwise, I will have this doubt in my mind because I'm not able to see, apart from 3-4 comments, I'm not able to see the comments. Okay. विकल्प से रास्ता थोड़ा डिफिकल्ट है. क्या डिफिकल्ट है? What PDF you have in your course, that is a small PDF. right? What PDF I am going to share, it is more difficult, right? The PDF you have already in your course, that PDF is a small PDF. The PDF which I am going to, for example, this PDF. See, this is the PDF which I have prepared, and a lot of things are here, right? So I am going to discuss all these things. So मेहनत तो करना पड़ेगा. Basically means you must have to understand. See, in your exam what they are going to do, generally the question will be what, either from very basic thing, or most probably question is going to be asked something which is relevant in the recent time of that topic, right? So either some basic thing, or they are going to ask question which is what, which is related to your topic and it was recently in the news because of any reason, right? Otherwise, see, suppose if I have to make the question, I have to go to the chapter and I have to read all the details, then I have to make a question. That is going to be a time consuming process. Other way is that I have an idea of broad structure of your syllabus and I went through last 6 7 months current affairs, and by going through the 6 7 month current affairs I got the fair idea that these things are in the news, and from those things I can make even basic questions and current related questions. So this is the normal way of creating a question paper for a competitive exam like yours. Okay, now see, risk management system in banks. So here it is mentioned what kind of the risk is possible for the banks. One is credit, interest rate risk, foreign exchange rate, liquidity, equity price, commodity price, legal, regulatory, reputational, operational. So these are the broader category of a risk. Risk. Credit risk, interest rate risk, foreign exchange, liquidity, equity price, commodity price, legal, regulatory, reputational, operational. Before moving forward, I will give you the brief of all kind of the risk which is already being discussed in this PDF. Right? But I will like to give you the brief about all kind of the risk first before taking one by one in detail. So when we say the credit risk, when we say what? When we say credit risk, what is credit risk in general? If I'll ask you to explain what is credit risk in general, can anybody explain what is credit risk? Anyone? Acha, today is Sunday, that's why less number of people are available. When banks is unable to pay deposit to the customer. When bank is unable to pay the deposits of customer, that is credit risk. Is this is a credit risk? Anyone else? उल्टा हो गया. When a person takes long credit and abscond. अच्छा. Borrower is unable to pay bank loan. Okay. Vijay Mallya case. Mhm. Vijay Mallya case. See, bank has accepted 100 rupees as a deposit. Okay, bank has accepted 100 rupees as a deposit, and as per RBI guidelines, first of all, they have to maintain what? CRR and SLR. CRR 4%, that is, suppose in cash. So how much is left? 96 is left. But they also have to maintain 18% SLR. So banks have to maintain 18% in SLR, and I have explained in detail in the past lectures. SLR generally banks put in the form of what? Put in the form of government securities, not in cash or gold, right? So out of 100, out of this 100, 4 is not going to generate any income, right? That 4 is not going to generate any income, so it is not an asset, or you can say that this 4 rupees is in the form of CRR and it is not going to generate any income for the bank because it is going to be remain in what? Cash. Fine. Now bank has left with what? Bank have to maintain SLR of 18%. So 18 rupees is invested by bank in what? GSES, that is government securities. How much is left with the bank? 18 plus 4, that is 22. Left is 78 rupees. Now this 78 rupees bank have to lend, right? The 78 rupees bank have to lend, and bank have to lend in such a manner the entire 78 plus maximum profit can be generated. Why? Because whatever the profit you are going to generate on this 78 rupees, of this profit, first of all, you have to repay this 100 rupees plus interest. 100 rupees plus interest you have to pay. So what actual profit of bank is going to be there, that is going to be calculated after deduction of what? The entire amount, 100 rupees plus interest. So bank will try to maximize their profit. But the problem with profit, maximum profit, that will leads to you where? Maximum risk. Maximum profit, if bank is trying to go for maximum profit, that can lead to what? That can maximum risk. Why? When you are going to lend the money, right? When you are going to lend the money, that money is going to give you some return. The point is, those who are what? Those borrowers, like government of India is also a borrower. Government of India is also a borrower. So government India is also borrower. Reliance Industries is also a borrower. In fact, the Vijay Mallya's company was also a borrower. Fine. So all these three companies are borrower. Sorry, Government of India and two other companies, for example, RIL and Kingfisher Airlines. All three are what? All three are borrowers, Government of India, RIL and Kingfisher. So Government of India's credibility to repay the loan is very high, right? It is very high, so definitely Government of India is going to pay the minimum interest. Whereas Reliance Industries is a good company, they have very good reputation in the market and they have never defaulted. So again, they are also going to offer less amount of interest when they are going to borrow money from the market. Whereas the companies who have less credibility, they have less credibility and there is a lot of risk involved because of less credibility. And if you are going to give the money, maybe your money is going to what? Completely vanish. So that's why those companies who have less uh, they have less credibility in the market, generally they are ready to borrow money on higher interest rate, right? So that's why their credibility is low and they are offering high interest. Fine. So if you want to maximize the profit, you have to lend the money who is offering maximum interest rate. And who is offering the maximum interest rate? The low credible company. That means if you will go for what? If you will go for maximum profit, then there will be a maximum risk will be there. Right? There will be maximum risk. So in order to do what? In order to go for this thing means we have to maximize the profit, but again we have to go for what? Maximum risk. Now we have to study to what extent we can take the risk, to what extent we can take the risk. So when you are going to calculate on this 78 rupees, the 78 rupees which you are going to what? Lend, right? 78 rupees is going to be lent, and on that lending the kind of risk is involved, whether we have to go for this company or that company, and if we will go for this company or that company, what are the prospects, what are the possibilities, what are the risks involved. Then all these calculations come under the category of what? Credit risk, right? So to assess the credit risk, we can go for what? To assess the credit risk, we can go for example, I have explained this thing already to you, that is credit rating companies. The credit rating companies. So bank can take a help of what? In order to go for proper credit risk management, bank can take the help of credit rating companies and just see and find which company is having a low rating. Low rating means what? That means the company's ability to repay the loan is low. That's why their rating is also low. And if the company's credit rating is high, then company have a higher ability to repay their dues. Fine. So in that way, we will get the profiles of a company through the credit rating company. And accordingly, we can go for what? We can go for risk management. Now we have 78 rupees. We have 78 rupees, putting this entire money in low risk asset or high risk asset. So we have 78 rupees as a bank. We can put this money in the lowest risk, or better than writing low, we can write it here. We can invest this 78 rupee in the lowest risk, or here we can go for what? Highest risk. Lowest risk means lowest profit. Highest risk means highest profit possibility. So what do you think? What bank have to do? What bank have to do? Jitendra Kumar, hello sir. Love you sir. Love you too. So what the course of action bank have to apply, right? The 78 rupees bank do have, and bank can go for what? Lowest risk. If bank will go for the lowest risk, that means bank is also going to make lowest profit. And with that lowest profit, maybe bank hardly able to repay that money, because bank is also have some operational cost, right? So that operational cost is going to be covered by the bank or not, if bank is entirely going for what? Lowest profit options. If bank is going to go for what? Highest risk option, then bank maybe lose each and everything, because the highest risk option bank has chosen. And either bank will go for what? The highest profit, and the customers are also going to get high interest rate, right? Bank can offer the high interest rate, but the same possibility is also there. Maybe people not only just lose their interest amount, they maybe lose their principal amount also. So what do you think? Either of the option is good or not? No option is good. No option is good. Bank have to go for various portfolio selection. Various portfolio selection. Various portfolio selection means 100% secure, right? Then bank have to classify where there is a less amount of what? Less amount of possibility. So for 100% secure, they are the government securities, and already bank has invested 18% of their SLR. Right. Now the rest of the asset 78, bank can again classify 78, some amount can further be invested in what? Some more amount can be further invested in the government securities, or bank can go for some amount to those companies who are highly trustworthy, right? So some amount out of 78, out of this 78, a percent is going to be what? A percent, then B percent, then C percent, and suppose D percent. So that is going to total how much? 78. So some amount in the low risk, right? Some amount in the low risk, like A, then B, then C, then D. So A is what? That is lowest risk, and D is highest risk, right? So you have divided your 78 rupees in that four kind of risk taking options, right? So some amount is invested here, some amount is invested here, some amount is invested here, and some amount is invested here. Now the percentage of this 78, maybe you are going to do what? You are going to put 40% here, right? Of the 78, of this 78, you are going to put what? You are going to put 78 ka, the 78 rupees, out of the 78, 40% you are going to put in the lowest risk. Then you are going to put 25 in the second. Then you are going to do what? Then you are going to do 15% here, 15% here, 40, 65, 65 plus 70, 80, and 20% here. Or you can reverse it. You can reverse in that same way. What? 20% here, and in the D you can invest 15%. So in that way you can classify your assets, and in those classification of assets you can put the assets in the different category as per this thing, right? Now if you have given the freedom to bank, if you have given this freedom to bank, they can go for assets classification on their own in order to invest that, right? So maybe bank can reverse it. Maybe bank can reverse it. They are going to invest how much? 40% in the highest risk option and only 15% in the lowest risk option. So that is why bank are being guided by the RBI to do what? You have to go for sectoral classification where you are going to put how much of total amount, right? So under the credit risk, bank have to do this thing. Fine. This is the one way of doing this risk. Portfolio diversification means portfolio here, it is not related to the capital market, right? What portfolio means? Portfolio is a generic term, right? It's an English word where we are going to classify the things. It is not related to the financial terms of what? Financial term in the case of portfolio investments. It's not related to that. It's a general term I have used here. The portfolio means just classifying your possibility with the classifying the assets where you are going to invest. So in that context I have used this term portfolio. It is not related to what? Capital market. Okay. अरे मनीष थोड़ा सा वेट कर लो, right? Have some patience. Within few days we are going to start, right? Just let me finish this part. We will start the descriptive part. Then I will give the question on daily basis. Don't worry. Yes, as per RBI guidelines, banks have to come up with their classification ki in what sector and how much of total 78. Out of that total 78, in which sector, how much you are going to spend, you have to give us a detail. Generally, RBI is not going to push. In general, RBI is not going to push, but RBI is going to ask you to declare that thing. Declare that thing of how much total you are going to invest in a particular sector. You have to clarify in your account books, right? And after that, RBI can set the limit. RBI can set the limit, for example, for particular sector, for airline sector or services sector, you can invest this amount 10% of your total liabilities. So total liability of bank is 100, and if RBI has set the guideline, under the guideline they have set only 10% can be invested, so you can invest only 10%. So that come under the category of what? Risk management or credit risk management. Here you have to what? You have to classify it. Clear? Okay. So this is all about in general. In general, this is all about what? This is all about risk, credit risk, right? It is all about credit risk. Now just move towards what? What I told you. See, I'm just going to explain all these things in general. Then in this PDF, you can find all those things in detail mentioned properly, and I will also go through with you. Fine, but just get an idea in general. Now the interest rate risk. How the interest rate is going to create a problem for the bank, right? Interest rate is going to create a problem for our bank. For example, how interest rate risk is there. Can anyone want to explain how this interest rate can create a risk for the bank? Interest rate risk, anyone? Interest rate risk is like very interesting thing. One of my relative, he have his own petrol pump, and they generally, petrol pump owner, what they do, they purchase petrol and diesel from particular company. So my relative have IOCL affiliated petrol pump, right? So they have IOCL related affiliated petrol pump. That means at their fuel station, they are providing the oil they have purchased from Indian Oil Corporation Limited, right? So suppose this owner want to purchase some 20,000 liter petrol from IOCL, right? And the price of petrol is X rupees. Fine. On what date? Today is 17th 4, or rather than X. क्या petrol का क्या price चल रहा है? What is the price of petrol right now? I don't know. I do not remember. That's why I'm asking. What is the price of petrol? Price with your location also. Anyone? Or everybody is like me कि भाई 300 का डाल दो, is a bike 300 का डाल दो, 1200 का डाल दो, rather than looking at what is the exact price of the petrol. $118. Where 118? And where is 110? Also mention your location. Where it is 110. And where it is 118. अच्छा, चलो चलो, we are going to take it as, for example, we are going to take it as 110, right? So the price of petrol is 110, right? 110. Fine. So suppose this petrol price today is 110, and by paying this price, he is going to what? He is going to sell. He is going to first what? Purchase this oil at the price of what? Purchase, this is the selling price. 110 is the selling price. But what amount he want to purchase? He want to purchase 20,000 liter from IOCL, and IOCL is selling to him, suppose that, at the price of 108 rupees. So he is getting the oil from Indian Oil Corporation at the price of 108 rupees, and he is selling that oil at the price of 110 rupees. That means he is generating the margin of 2 rupees. That means after the selling of this petrol, 20,000 liter petrol, he is going to generate the margin of how much? 40,000 rupees. If he is going to sell this 20,000 liter, he is going to generate the margin of how much? 2 rupees. At what price Indian Oil is selling? Indian Oil is selling at the price of how much? Indian Oil is selling at the price of 108, and we are getting at the price of how much? 110. So dealer is making the profit of how much? 2 rupees. Same condition is for bank also, right? So that's why I want to share this example with you. Now the price he is going to pay to purchase this oil. He is going to purchase this oil at the price of what? At the price of 108, and he is going to sell what? He is going to sell at the price of 110, right? So they have purchased that oil, and from tomorrow they are going to sell it. Fine. In between, government has announced that we have reduced the tax. We have reduced the tax. Suppose government has announced we have reduced the tax on petrol and diesel, and that's why effectively price is going to be reduced by 4 rupees. So government has announced. So by midnight, the price of petrol must be decreased by how much? 4 rupees. So rather than 110, he must have to sell at the price of what? 106, right? Because as per the announcement of the government, the price must be what? 106. So if you have purchased at the price of 108 already, you have purchased at the price of 108 already, you have to sell from 18/4/2022, right? So in that case, what is going to happen? In that case, you are going to have a loss of how much? 80,000 rupees. Fine. But another scenario, suppose government has announced we are going to increase the tax, or oil company has announced we are going to increase the cost of our petrol from how much? From 108, we are going to increase it by 4 rupees, and it is going to be what? 112. So you already have purchased at the price of what? 108, right? You already purchased at the price of 108. Now Indian Oil has said that, made an announcement that we are going to increase the price by 4 rupees. So now you have to sell at the price of 114. Earlier you were selling at the price of how much? 110, but now you have to sell at the price of 114. So earlier you was getting the profit of 2 rupees, but right now additional 4 rupees. So on 20,000 liter petrol multiplied by 6, you are going to get the profit of 1,20,000. So change in the price, there is a risk involved for the dealers. For the dealer, risk is involved if the price is going to change. Fine. 105 in Mumbai. 110 in Lucknow. Lucknow में 110 and Mumbai 105. Manish, अच्छा, Sikar Rajasthan, it's 112. अच्छा, okay. लाहौल बिला कुवत, लखनऊ वालों ने तो प्राइस बहुत ज्यादा कर दिया है. Okay, so I hope you got the point कि how this change in the price is going to change in the profit or loss for petrol pump dealer. Similarly, in the banking sector, in the banking sector, interest rates is on lending and deposit, both two kind of the interest, right? One is on lending, other is on deposit. Can you tell me who regulates? Who regulates this interest rate? Who regulates this interest rate? In India or in any country, there are the two kinds of the interest rate. One is lending interest rate and another is deposit interest rate. Who regulate this interest rate? Is lending rates are regulated by RBI or banks? Who decide their lending rate? Lending rate is decided by RBI. Okay. So what you want to say is RBI have power to fix minimum interest rate and maximum interest rate, both. Do RBI have this power to fix minimum interest rate and maximum interest rate both? For deposit, banks themselves, and lending by RBI. So in case of lending, can RBI fix the minimum interest rate as well as maximum interest rate both? Or only minimum interest rate or only maximum interest rate? See, now in India, interest rates are deregulated, right? Deregulated. That means banks have a freedom to fix their interest rates, right? Banks have a freedom to fix their interest rates. Number one. But that power to fix interest rate is based on certain rule and regulation. For example, while deciding your lending interest rate, you must have to follow MCLR, marginal cost of lending rate system. Marginal cost of lending rate system, MCLR system must have to be followed. So you can fix your minimum interest rate as per the MCLR system, right? Marginal cost of lending rate system can be followed. MCLR can be followed. On the basis of that, you can fix your interest rate, right? No RBI make in between a basket. So the point is RBI will provide you what? RBI will provide you a freedom, but that is not absolute in the nature, right? RBI has deregulated the interest rate, banks can fix. But while fixing their interest rate, bank cannot go out of that brackets, right? Or what Manish is saying, basket, but out of that bracket. So in that bracket, you are free to fix, right? Beyond the bracket, it is not possible. Sometimes people say that then why you are saying that they are deregulated? Deregulation doesn't mean that you can go out of mind, right? You cannot go out of mind. You are doing a public business, so you must follow the fair business practices. So under the fair business practices, we have given you what? Freedom. For example, internet company provides what? Fair usage policy. So under fair usage policy, you can go to that limit. Beyond that limit, we will decrease the speed. Similarly, here you have a freedom, but that freedom is limited in the certain context. Fine. So both interest rates are what? Both interest rates are deregulated, right? But the certain bracket is being there. Now, under the monetary policy, Under the monetary policy, RBI do what? Under the monetary policy, RBI fix certain lending rate and reserve rate, CRR and SLR. Here, repo rate, reverse repo rate, then marginal standing facility, and is bank rate. Right. So this is done by whom? RBI. And when this action is taken by RBI, the objective is what? Money supply either have to increase or have to decrease. Right? So this action is taken by whom? This action is taken by Reserve Bank of India while changing this interest rates and reserve requirements. Now, under monetary policy transmission, RBI took the decision. Now banks have to follow and provide the thing which RBI, if RBI want to increase the liquidity, right? So RBI took some certain decisions. Now this decision have to be implemented by banks on the public. So RBI want to increase the liquidity. In case of increase the liquidity, RBI went for what? Target is increase liquidity, right? So RBI has decreased the interest rates decrease. Now that must be followed by banks also. Banks also have to decrease their interest rates. So in order to decrease the interest rate, then if you have already decided you are going to lend this money on floating interest rate, there is one fixed interest rate and another is floating interest rate. So when you have given that loan, you have anticipated what this is going to be the minimum interest I am going to receive, right? The minimum interest is we are going to receive. But RBI has changed its stance, and with that instance, what is happening? Interest rates are going to be lower, and in that case, you may not receive that amount of the interest which you have anticipated earlier, right? So this is why before going for calculation how much I am going to get, suppose bank is going to give the loan of 50 lakh rupees to its customer for in the form of home loan. So when bank fix this interest rate 6.48%, suppose that this is the interest rate bank has fixed for what? Suppose home loan. So while fixing that interest rate, bank have to keep this thing in their mind. Not only just what? Not only just credit risk, but bank also have to be mindful of what? Interest rate related risk. So if you have miscalculated and RBI for a duration means for the 4-5 years duration, RBI has increased the interest rate or decreased the interest rate, then your entire calculation is going to be what? Wrong. And in the longer run, you may face what? Low performing asset. You anticipated that asset is going to perform very well, but because of your miscalculations, misjudgment regarding the interest rate, you have unnecessarily increased your what? Increased your risk, right? So that is why the interest rate related risk also must have to be taken care by the bank, right? Right? So I hope you got the idea what is the thing related to what? Interest rate risk. Interest rates related risk. Is it clear? Interest rate related risk is clear? Okay, next was what? Next was foreign exchange related risk. Foreign exchange related risk. How this foreign exchange related risk create a problem for the banks? Anyone want to try? How the foreign exchange related risk is going to create a problem for the bank? How banks are exposed to foreign exchange related risk? How banks are exposed to foreign exchange related risk? Anyone want to try? See, banks do accept deposits. For example, there is FCNR. FCNR, right? FCNR account. What is the full form of FCNR account? What is the full form of FCNR? Change in the value of rupee affects forex reserve. So that is related to forex reserve, na? Foreign currency reserve. I'm talking about bank. Forex means what? That is going to impact our ability, right? That is going to affect our ability, the ability of India, right? I'm talking about what is going to impact on banks in India, not government of India. I'm talking about banks. So FCNR is foreign currency non-resident account, right? So foreign currency non-resident account. In these accounts, banks do accept deposits in foreign currencies, and they also repay principal amount plus interest amount in that currency, right? So suppose that you took the deposit of $100, right? You took the deposit of $100 for 5 or 1 year. Took the deposit of $100 for 1 year at the interest rate of suppose 6%, right? 6%. At the time you took the deposit, $1 was 70 rupees, right? $1 was 70 rupees. So you took the deposit of how much? You took the deposit of 7,000 rupees, and on 7,000 rupees, because $1 is how much? $1 is 70 rupees. So you took that $700, that is 7,000 rupees, and you have to pay the interest of how much? 6%. That is how much? 420 rupees. 7 6 are 42, that is 420 rupees you have to pay the interest. This is what you have anticipated. Now after 1 year, what happened? $1 is equal to how much? 80 rupees. So how much principal you have took? 7,000, or $1 was 700, sorry, $1 was 70 rupees. You took the principal of how much? You took the principal of $100, and that in Indian currency it was how much? 7,000 rupees. But after 1 year, when the dollar is going to be what? Dollar is going to be 80, then actually the principal amount which was at the time of deposit was 7,000. Now it is going to be how much? 8,000, right? And the interest rate is going to be how much? 480 rupees. So you thought that you have to return what? 7,420 rupees, but now you have to return how much? 8,480 rupees. So you are going to pay extra 1,060 rupees. Fine. So you are exposed to what? You are exposed to the foreign currency. And if the value of foreign currency is going to decrease, then bank is going to be in the profit. But if the value of foreign currency is going to increase, then with the FCNR, banks are what? Banks are at greater risk. That is why when I said ki interest rates are deregulated, when the interest rates are, I said that ki interest rates are deregulated in India. But there is an exception. What exception? When banks are going to accept the deposit for this kind of account. If banks are going to accept any deposit, right? Any deposit, banks are going to accept any deposit in foreign currency, then interest rates are regulated by RBI, right? So RBI is going to fix what maximum, what minimum interest rate you can offer, right? That means what? In the domestic deposit, in the domestic deposit case, domestic deposit means in the rupee deposit. Rupee deposit, the maximum and minimum. This is having this width. Means lot of space is there. You can, lot of freedom is there to fix what? Lot of freedom is there. Freedom is there to fix. But in case of what? Foreign currency deposit, this freedom is very limited. This freedom is very limited in the case of max, in the case of minimum. So there is a less amount of freedom, because if RBI is going to give lot of freedom to banks, then banks are going to have one of the biggest exposure to foreign exchange related risk. That's why RBI controls the deposit interest rate given by the banks on foreign currencies. Right? So in this way, the banks are exposed, but banks are less exposed with respect to what? Foreign currency related risk. Okay. And apart from that, banks are also involved in foreign currency trading, selling and purchasing of foreign currencies, right? Banks do sell and purchase, because even sometimes RBI also offer selling and purchasing of foreign currencies to banks, right? So under the risk management, I told you na, under the risk management, when I was explaining here this thing, right? A, B, C, and D. So one of thing is here what? Bank's portfolio. One of the bank's portfolio is their business in foreign exchange. Bank's business in foreign exchange. So RBI will set how much of your total liabilities. Bank took 100 rupees from customer. So out of that 100, right, how much you can go for foreign exchange related business, right? That is going to be fixed by whom? RBI. So in that way, RBI is going to limit your exposure or limit your risk with related to foreign currencies. Number one. Second thing, when you are going to accept the deposits in the foreign currency, again it is going to be limited by who? RBI. Because this is the foreign currency related risk. Even government of India or RBI, if they are going to make it free, okay, banks, you can go for it, whatever you want. In that case, you are going to be liable from other countries' authority to repay, and it is going to create a big problem. So that is why still the foreign exchange related business, it is highly regulated by the Reserve Bank of India. So generally, if you will talk in terms of Indian banks are least exposed. If you will compare the G20 countries, you will find that Indian banks are least exposed to foreign exchange related risk. नहीं 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 नहीं, फॉरेक्स से एसएलआर नहीं मेंटेन कर सकते आप। फॉरेक्स से एसएलआर नहीं मेंटेन कर सकते सर। मनी तो डॉलर में भी रीपे करना था, रीपे करना था, बट यू आर नॉट गोइंग टू होल्ड द डॉलर ना, you are going to use that dollar at some place. So that's why I'm telling you ki you have to, you took the $100, you took the $100 and you have invested somewhere, right? So Indian bank, when it is going to purchase the dollar, right, or bank is going to get $100, so you are a bank, I have deposited my $100 to you, and you have promised me you are going to repay 6% interest to me. So what you are going to do? Are you going to hold that dollar in your pocket? If you are going to hold that dollar in your pocket, how you are going to give me the interest? Right? You are not able to pay the interest, then what you will do? You are going to use that dollar at somewhere, either at the international level or in the domestic. So if you are going to use that money in the domestic market, you have to convert that dollar into what? Rupees, and you have to use it for the purpose wherever you want to use it. Similarly, when you have to repay, then you have to convert that rupee again in what? Dollar. So you have to pay higher amount of rupee what you have anticipated in the beginning. You have anticipated you have to return only this amount of money, rupee, when you have to return that dollar. So this is what I was saying. Change in the value of rupee affects the forex reserve. So this is clear. What we mean to say, what we mean to say foreign exchange related risk. Acha, now okay, tell me, what is liquidity related risk? What is liquidity? I told you liquidity is defined in terms of degree, right? Liquidity is defined in terms of degree. High degree to low degree of liquidity, right? So suppose again bank have 100 rupees in terms of what? Liability. Bank have 100 rupee in terms of what? Liability. That means they have taken 100 rupees as a deposit, out of which 4 rupees they have put in the form of CRR and 18 rupees they have put in the form of SLR, and they are left with how much? They are left with 78 rupees. Fine. And out of this 78 rupees, 60 rupees they have invested in non-liquid assets. Non-liquid assets, right? Non-liquid assets means for the entire duration there is a lock-in period. So you have invested your money out of 78, 60 rupees you have invested to that asset where that 60 rupees is locked for how much? Suppose for 1 year. So 1 year the entire money is what? Locked. The entire money is locked for 1 year. And how much is left? 18 rupees, right? Now in between, in middle of this year, when you have went for this 100 rupees as a what? Investment in the non-liquid assets, in the middle of year, you need some liquidity. You need some liquidity, right? Bank needs some liquidity, but bank have invested the major chunk, or you can say that almost 80% of this money in the non-liquid asset, and you need money at that point of time. So you have money, but that was invested at that place where you cannot take it because it's a lock-in period or it is a non-liquid assets. So bank cannot sell that assets in order to get some liquidity for small duration. In that case, what you have to do? In that case, you have to borrow the liquidity from other banks. Fine. So unnecessary, there will be extra burden on you because you have money but you cannot use it. Why? You have put it somewhere, from here you cannot take it. For example, a person have a 10 lakh rupees in their PPF account, right? He have 10 lakh rupees in his PPF account and he need 1 lakh rupees loan right now. So because the PPF is completely non-liquid, there is a lock-in period of 7.5 years. So 7.5 years, or as per decided by the government time to time, if the 7.5 year lock-in period, just an example, 7.5 years, there's a lock-in and you need money right now, you can't do anything. You have to go to the bank and borrow the money. But if you have deposited that money in the bank in the fixed deposit, maximum what is going to happen? Maximum you have to break that FD. Some penal interest rate will be applied, but whatever the penal interest rate going to applied, it is not going to be more than the interest which you are going to pay when you are going to borrow that 1 lakh rupees from the bank. Okay, you are going to borrow 1 lakh rupees from the bank because your money is in PPF. So you have to pay the principal amount and interest amount when you will borrow 1 lakh rupees. Fine. Because the 10 lakh rupees was in PPF and you are not able to get the loan, right? Or you are not able to withdraw the money from there. But if you have that money in your fixed deposit, which is breakable, right? Kind of the thing, or in the saving accounts, you can withdraw from there and you can use that money. Fine. So similarly, banks also have to take care of the short-term liquidity, medium-term liquidity, and long-term liquidity management properly. Otherwise, unnecessary, they will put burden on themselves. Fine. Clear? What is the liquidity related issue or liquidity related problem? Now, equity related prices or commodity related prices. Equity related prices and commodity related prices, suppose that bank is involved in the equity trading, means bank has purchased the share of particular company, right? Bank has purchased the share of particular company and at that point of time the price was high, later on price is going to down. So these two cases. Generally, in India, banks are not allowed by RBI to expose themselves. Banks are not allowed by RBI to expose themselves too much, especially in these two kind of business. Merchant banks can do, but generally, non-merchant bank, they are not allowed by RBI to expose themselves too much in that case. So automatically the risk is low. However, whatever the risk is, suppose whatever the bank has purchased a equity or share of a company, but after certain point of time, the price is going to down. So bank thought that we will hold the equity of particular company, right, for a year. After that, we will sell it, right? We will sell it because bank is anticipating within a year company is going to have a phenomenal growth and the price of shares are going to rise in the market. So with this anticipation, you have purchased what? Equities. However, the time when you are planning to sell it, even before that time, the price is going to what? Price is going to down. Then there is a risk involved here. But again, what I'm going to mention, banks by the RBI are not being allowed to expose themselves. What I mean to say expose? Expose means now you are clearly vulnerable. So RBI do not allow you to expose. RBI will allow you, okay, you can go for certain amount of portfolio investment. In what? Portfolio investment means certain amount you can invest here also. But that limit is going to be fixed by RBI very less. So you are not going to be exposed too much in these two cases, right? Now, legal and regulatory. Legal means what? Bank is going to be in problem. Sometimes government has changes their stance. For example, Jandhan account. In the Jandhan account, bank need not to charge some money. They have to provide interest-free or charge-free services. So if suppose that government has made it what? Government has made this legal. Every bank have to provide saving accounts. Every bank have to provide saving accounts to all the citizens up to 5,000 rupees, right? Up to 5,000 rupees means if you have 5,000 rupees in your account, bank cannot what? Bank cannot charge anything. Or suppose government is going to make it mandatory. No frill accounts means banks have to open account of everyone whosoever is interested, and there is no condition for minimum balance. Right? There is no condition precondition to maintain a minimum balance in that account. So that is going to create a lot of problem for the banks. So sometimes these legal things are going to very problematic. If government is going to change the rule, right? Bank has anticipated, but bank whatever the anticipation was there, government has changed the rule. Government said that we are going to waive off the loan. Right, government is going to say that waive off the loan. Government is going to say that we are going to increase the priority sector lending amount. So all these legal things which is coming from the root of the government again going to create a lot of problem for the banks. Right, now the regulatory I given you the example of what monetary policy transmission. If bank is not going to accept the monetary policy transmission, then regulator is going to punish you. So that case was also the interest rate related and regulatory related, both are interrelated. So sometimes regulatory, for example, bank have to maintain minimum capital adequacy ratio as per the RBI guidelines. So you have to maintain that adequacy ratio which is put forward by whom? RBI itself. So you have to withdraw the money or whatever the money you have planned to invest. Now you have to change the complexion of your investments as per regulatory guidelines, which may alter whatever the prospects you have seen at the time of investment. But now the regulator has changed its stance. Now the prospect of what to get more profit is going to change. So this is the way how you have to go for what? How you have to go for regulatory related risk. Reputational and operational. Reputational means what? Vijay Mallya ran away, right? Lot of other people ran away. If bank is not going to fight the cases against those people, right? Bank is not going to fight the case against those people, the big defaulters, then the reputation of bank is going to be what? Tarnished, right? So in order to save their reputation, you have to fight the election against, sorry, not election, you have to fight the case against those fugitive in the foreign country court, right? Where you have to put lot of money in order to save your reputation, right? In order to save your reputation, you have to put the lot of money. Despite knowing that this is going to too much, right, on our expenses, but still you want to fight your reputation. That's why you are fighting case in those foreign countries against those fugitive, because you have to maintain what? Your reputation. Similarly, from operational things, sometimes bank say that okay, we are going to what? Lay off our employees, right? Or we are going to hire more employees for that particular business, because as per government guidelines we have to do that business, and as per the government guidelines we have to do that business, and for that we need more people, right? So assets are not going to increase, but the liabilities in terms of operational requirement, it is going to increase. For example, if Windows is going to say that we are going to stop the support, then in that case you have to purchase all new devices, all new communication devices. So in that case you are going to be exposed to operational problems, right? So that is the kind of what? Operational risk which is involved here. Right. So these are the broader category of risk which may be there. So this is what the broader classification. Right. Now, step by step, we will go into the particular broad. We are not going to discuss all these things, but which are prominent one, especially these: credit, interest, foreign exchange, and liquidity. These four are the most important risk management pillars. So we are going to discuss this risk management pillar related to credit, interest rate, foreign exchange, and liquidity in point wise, what I have given you today, that is broader understanding. But tomorrow, when I will take this, I will give the pinpoint terms which are related to risk management related to it. And it is going to take maximum 30 to 45 minutes to cover it up. Once it will be covered, then I will let you know what are the guidelines given by the RBI for prompt corrective action, right? What is that for the risk management? And I will also discuss the camel part. Camel part will take some time. Camel part will take some time. So probably in the next class, it is going to be one half hour to 30, 40 minutes is required to explain those technical terms, and then 1.5 hour is required to explain the camel thing and prompt corrective action. So tomorrow I will wind it up, this part. But I hope what I have explained till then now it's clear. Okay. So we'll continue from here tomorrow. Fine. So good night to all of you. See you tomorrow. Okay.